Hi, my name is Harris. I'm one of your podcast hosts. I'm also a lawyer at Treadstone Law. For most Canadians, buying, selling, or refinancing real estate, a lawyer is the last thing on their mind. That's unfortunate because lawyers play a vital role in the process. But what choices do Canadians have? Lawyers can be very expensive. Well, Treadstone Law offers resources to Canadians so they have access to the information they need. Whether you sign up for a live workshop or a mailing list, we cover topics to help you make informed decisions and avoid costly mistakes. It's advice you can start using today, and best of all, it's free. Visit treadstonelaw.ca/MAS offer or click the link below to get access right now. If you're looking to retain Treadstone Law, it's never been easier. Our entire process is online. From completing the retainer agreement to your signing appointment, everything is done from the comfort of your own home. We're your digital lawyers. The best part of it is that you don't pay anything when you're retaining our firm. Visit treadstonelaw.ca/MAS offer or click on the link below to retain us right now. Enjoy the podcast. Welcome to another episode of Hustle and Grit. Today, I've got Daniel Patton on our episode. Daniel Patton is the co-owner of BM Select and has been helping investors scale their real estate portfolio for over 15 years. BM Select is a number one mortgage team in Canada for the last 4 years, and in 2021, funded over $600 million in mortgage transactions. BM Select continues to be the industry leader for investors when it comes to buying and selling real estate. Welcome to the podcast, Daniel.
Thank you, Harris. I really appreciate it. It's almost like I wrote that myself, such a nice intro. Thank you. Yes.
I did a little bit of searching before our conversation, and I saw that, on your profile on LinkedIn, mortgages is the only thing I see. So it's safe to say that this is kind of your career. So just to kick it off, what got you into mortgage brokering? Is it something that you fell into, something that, you're actively decided, like, this is what I want to do? What got you into the industry?
So my best friend, my brother, my best friend, Dave Butler, I grew up with, got into mortgages about a year before me. So when I had no idea what I wanted to do as a career, to be quite honest. I was one of those kids. I didn't do well in school. I had a hard time focusing. I didn't like class. I was always pretty bright, but I didn't like conforming to your normal school. I suffered from ADD and things like that. So it was tough. It was tough for me to fit in school. So I had no idea what I wanted to do, but I, for whatever reason, decided I thought being a police officer would be a good career. So I went to college to be a police officer, and that was a 2-year program. So I was about 21 when I did that till about 23. And after that, I just started applying to be a police officer. And while I was applying, Dave, who I had mentioned earlier, my best friend, had started doing mortgages for a year. His dad was sort of doing it for about 5-10 years before he got into it. So he just learned it from his dad. And he came to me and he was like, listen, like that, my family's always sort of said to me, my dad's in sales. My mom was in sales. They're like, be in sales. You were born in sales. So when Dave came along and said, look, we sell money. That's what mortgages is. You sell money. I was like, maybe I'll give mortgages a shot. And so while I was applying to be a police officer, I was working as a bartender. That's how long I was literally working as a bartender 20 years ago. And I started doing mortgages 3 times a week. There was no base salary. There was nothing. I would just drive to Dave's house, and it was a house, and I would sit in a bedroom, and he worked in another bedroom. Those were our offices, and I would just listen to him do mortgages. And at night I would bartend and serve and make my money that way. And then after about a year, I started to get a couple deals here and there. And, I started to realize if I put more time into the mortgages, I'd probably make a little bit more money than I was making in restaurants. And 20 years later, man, here we are.
No, I mean, the first thing that you kind of talked about really hit home for me when you're saying that, like, you're not good in school. And like, I feel like for a lot of people, like, we're just kind of told that you have to be good in school, but school's only a certain way of learning. There's a lot of people with a very high aptitude that can't, they just got to see what's outside of the box. They can't stay within the box. And I think mortgages is a perfect kind of example for that, because especially nowadays with the amount of products and services that are available. It's just insane that like how much you need to know, how much relationship building is involved. It's not just about numbers in order to get like a really good kind of service given to your clients. So
Yeah, I couldn't agree more, especially when you're an investor, right?
yeah,
I work a lot with investors, but when you're an investor and you're sort of working with many different banks and many different products, you're absolutely right. I mean, the knowledge and sort of the ability to shift from one to another quickly is super important. You know, I mentioned ADD. I sort of talk openly about that because I know as somebody who suffered from ADD, and maybe you did too. That's why a lot of people, entrepreneurs don't always do well in school
yeah,
because of
yeah,
stuff like right. And I think that when you're young, you spend a lot of time getting into trouble because your attention is drawn to other places. You talk to friends, you're
yeah.
distracted, you want group activities, right? So you spend a lot of time getting into trouble. But I think later in life, you know, what you don't realize when you're young is that develop such helpful skills when you're older. You learn how to read people, you learn how to interpret people's mannerisms, you develop a sensitivity to reading people through these challenges when you're young, that as you grow in sales,
Yeah.
like somebody like myself, it's massive. That's how, as you said, you know, it's all about relationships. I feel like I have a you know, maybe a unique ability like many others to just, you know, read people maybe a little bit better than others, judge their mannerisms, the way, the tone of their voice, the way, you know, if they're being
Yeah.
aggressive, if they're being passive. I think that certainly helps, you know, when you're running a business, you know, like myself, or when you're working with clients and trying to build relationships.
Yeah, I mean, even with like, I think that really hones in, especially with investors, and investors would know, like, when you're buying a property, it's not always that as easy as putting in an offer, right? The person who wants that offer wants to know that you can pay. You have to figure out, you have to deal with so many different kind of moving parts that it's not about the numbers. Like like, I think people very quickly find out. Me, just drawing from my own experience, when you're in law school, they just teach you like, you know, you got to read this. This is the law. And then this happens, and this and this and this. If they don't do this, that's what's going to happen. In reality, that's not the case. It's about, you know, it's a very human process that you're really kind of building a relationship with people. It's not about like this fine line of like just math where sometimes that is what it's brought down to, or it appears to be with mortgages, where it's like, this is how much you qualify for. But a mortgage broker would know more than anybody else that to get that number, you're looking at banks, you're looking at relationships, their risk tolerance. When you read something, is what's behind that meaning? What does it really mean when they say you qualify for this? Like, it's not something that's like you can just say, okay, well, I read it, so that means that they must accept it. You got to know the people behind all of that. Quick 10-second break. Are you finding this podcast useful? Do you want access to more resources just like this podcast? Sign up to one of our online workshops or our mailing list, and we'll send all the information you need right to your inbox. Good advice is hard to come by, especially in a market like today's. Sign up by visiting treadstonelaw.ca/MAS offer, or click on the link below. Enjoy the rest of the podcast.
They call it the game within the game. And
Yeah.
you're absolutely right. You know, there's the surface rules, especially like you mentioned, you know, as an investor, every bank is very different on how they qualify investors, right? Scotia's different than TD, who's different than RBC. They use different rental amounts. Like, you really have to understand the knowledge of each bank and how they're going to view a deal. I mean, that's key to an investor who's trying to scale a portfolio, you know, buy more, you know, we see it all the time. A client may get declined at one bank because of the way they underwrite a file, and you know, the next bank over here will take that deal on. But the game within the game is huge, because if you're able to understand, this is the thing I tell investors too. You know, I don't mean to focus solely on investors because we work with a lot of other people, but
Yeah.
I tell investors this is the cold hard truth, and the reality is that, you know, the banks, you know, don't love your business when you're an investor, right? That's the cold hard truth. Most people who are investors have things like equity. They have, you know, ways to qualify. They usually have a little bit of disposable income. So they're not used to being told no. What we have to understand and appreciate from a bank's perspective is a bank is a business, right? And the design of a bank isn't to just give you a mortgage at a low rate. That's not the design of a bank. The design of a bank is to get you when you're young in a good way, right? Bring you in with, savings accounts, and then develop that into debit accounts and credit cards and RSPs and mortgages as an ancillary. It's to develop a long-term relationship with you. But investors, for the most part, aren't looking for that, right? What's the investor looking for? They're looking for a place to park their mortgage at a low rate.
Yeah.
That's what they want.
Yeah.
They're not looking for anything else. So the banks recognize that. So there's this sort of game you're playing, as you mentioned, where it's like the banks don't really love the business, but if you can fit inside this little box of rules that they say and give them, what they're looking for, we have the best shot to borrow the money from them, which is really what we want. So things like interest rate, although it's important, you're bang on. It can't be the driving force. The driving force is let's get the approval, especially on rentals when you've got, deductible debt and things like that. So rate is important for sure, but the approval always reigns supreme. And that could vary from bank to bank, depending on how many properties, how many HELOCs you have, all that stuff.
Yeah. I mean, rate, like, honestly, rate, it's so overrated where I could quote you a half a percentage point. What does it matter if nobody's getting approved, right? Like it means nothing. It's all about not just what you're getting approved for, but your entire portfolio. And with banks, I find it's like, banks are, like you said, they're working in this box, and it's like they got a shoe size 10 and a 12. And if you're an 11, they'll give you a 12 and say, at least like it's a little bit loose, but you'll get used to it. All right. Whereas if you really want like that relationship, right, I personally had always advised my clients, anybody who comes to me, it's a no-brainer. You have to go towards a broker because they're specialized in something. They're specialized in specifically mortgages, and if it's an investor, they're looking at your entire portfolio. It's not necessarily not even the next property. You could actually talk to a broker about the next 5 properties. How are we setting up that play, right? Whereas with a bank, it's kind of like, let's talk about the next property. By the time you get to the second property, is that same manager around? I don't know. It's like, are they gone? Like, you don't really have that continuity that you do with a mortgage broker to build that wealth.
I would agree. The thing with the bank is you can, there's always good people at the banks, and the banks have product. We like the banks. We like their product. We want to borrow it. This is what we're trying to do, right? But the problem sometimes with the bank that we find is the bank is your best friend, and they give you answers that fit the bank. So if the answers they're giving you only service the one bank that person works for, then whose intentions are they really looking out for, right? Yeah. It's yours as long as it stays with the bank. Now, that doesn't mean that there's not good people at banks that might tell you, look, try this other bank. Look, it's possible. But that's where a good mortgage broker would shine, certainly in something like that. Interest rate can be important. Like you said, when you're a first-time buyer and you're working maybe with 5 or 10% down, there's more. Now you have way more options, because when you're buying at less than 20% down, buying owner occupied, most people don't know this, but the qualifying is all the same from every bank. It's not the banks that's approving you when you're buying less than 20. It's the mortgage insurers, right? And there's only 3 of them: CMHC, Genworth, and Canada Guarantee. And Genworth changed their name to Sagan, but I know them as Genworth. But there's only 3. And their rules are all the same. So when a bank is getting you approval at less than 20% down, they're all going to be the same. So there you have a little bit of an advantage to shop rate. You can maybe look at, monoline lenders who compete with big banks and offer lower rates because they're not as known and they don't have as many product as a bank. But for an investor, for sure, rate isn't as important. So a good mortgage broker would have a conversation with the client up front and figure out, what is it you're trying to do, as you mentioned? Looking to scale your portfolio? Are you looking to just buy one property? Is this owner occupied? You're looking for the lowest rate. I mean, that's the job of the mortgage broker, is to adapt to whatever the client wants. That's our job ultimately.
Yeah, I mean, and again, I don't mean to knock on the banks. Ultimately, you're getting a mortgage from a bank.
No, go ahead. Better you than me, man. Better you than me, Harris.
So all I'm trying to say is, like, you know what? Like, there's so many products out there. Honestly, like, if you go back 50 years ago, a mortgage is a mortgage, right? And maybe I'm oversimplifying it, but now, I mean, I'm a lawyer working within the periphery of what you guys are doing. And I mean, there's insured, insurable, uninsured. There's so many different products. Some banks do a certain amount of doors. Some banks do certain amount of like rent will be counted towards your income. And it also changes with brokers as well. Like so there's so many balls that are kind of in the air that
Yeah.
like it's not easy. And it's like for one person as an investor, my thinking is you are employing yourself to go find the best property. You're not employing yourself to run to 50 banks every single time you've got the property to find the best financing, right? The perspective is to get the one property and make sure you're there with the right advisors so that you can get that property and have that offer accepted and make the confident decision when you need to. So
Yeah, I would agree 100%. I'd agree 100% with that. It's, we want to sort of, we're always conscious. Again, I'm not trying to hammer. We're always conscious of interest rate for sure, but we're usually playing in the field of the big banks for the most part. And there's reasons for that. As an investor, we want things like 30-year amortizations. Well, that's only available through big banks for the most part, at that rate. We want things like access to home equity lines of credit. So, there's questions, do you want to sacrifice those options to just get a little bit of a lower rate? Most people, when you're talking investment properties, they don't, because that's how we're leveraged. That's how we're acquiring these properties, is most people are leveraging equity in their existing homes. So you want that flexibility to add lines of credit. And that's product for the most part only big banks have.
So changing gears a little bit. So if I'm like a first time investor, what's the process like working with you? Do I give you a call and say, hey, listen, I want to invest or have a property, or what is kind of the journey?
Yeah, so this is a good question because we're a bit different than most mortgage brokerage offices. I started out as a mortgage broker, which I had a client. I would take their info and I would put it in the computer and I would run their numbers. I would tell them the pre-approval. When they got a deal, I would input the deal and send it to the bank, collect the dot. I did everything. But we've been blessed with a lot of growth in our career, and we work with a lot of big investment groups in Southern Ontario and across Canada. So with that, my office has morphed into more of an office, just that. I've got 40 people that work for me now. Most mortgage brokerages or real estate offices design their office to have a lot of mortgage brokers that work for them. And a mortgage broker will normally take the deal from start to finish themselves. There might one point of contact, but our office is a bit different. Our office is built around two salespeople, myself, and I have Mike Zanzini, who is he's our top sales guy. But the rest of my staff is, I have underwriters, I have doc collectors, I have admin, I have HR. We've been blessed with that. So our process is a bit more automated. Now, we never want to lose the personal touch, right? So if I ever have a client that wants to have a conversation up front or wants to chat with me, I always want to make myself available. There's no doubt. We know customer service is at the forefront of what we do, but we also try to be as efficient as possible. So most of the time, what will happen for us is we'll be referred a client through one of our referral sources, whether it's a realtor, an investor coach, an investor company, and they'll either email myself or my assistant, and we'll respond back with an opportunity to either start to collect their info. Usually they'll email us and say, hey, I was referred by this person and I'm looking to purchase an investment property. So most people are looking for the same thing. They want to know their max pre-approval numbers. They want to know, can I pull money out of my house? Maybe they're a little complicated and they say, well, I'm self-employed. I want to talk first. I don't show all my income. So there's things like that we always want to accommodate. But the idea for us is to get their info in, process it. That's what my team is trained for, how to process an investor's application and get it to the point where myself or Mike will arrange a Zoom meeting, much like, you and I are doing. And we do a face-to-face meeting. We can do it over the phone. In person's a little tougher. We used to do it in person before COVID, but now it's a little bit more digital. But we'll spend time with the investor at that point. We'll spend an hour. We'll share our screen. We'll show them the different ways that the banks are going to see their numbers. We'll show them, well, this is the cost of pulling money out. We actually spend time with that investor going over a game plan with them, because we want to know, what's your plan? Are you planning on buying 2 or 3 properties? Are you planning on buying 5 to 10? Are you buying residential? Are you buying commercial? Are you buying flip? Like, there's so many different ways. So we want to get a bit of an understanding on what the client, is trying to do. But that's the bulk of, our time is spent meeting with the client and going over that. Now, after that meeting's done, we give the client pretty much the green light to start shopping. Market's a bit nuts right now. So, out there shopping. They may call us. They may want to talk to me before putting an offer in. No problem at all. We accommodate stuff like that all the time. But, the mortgage broker's job in the sense of the investor is done at that point from the pre-approval standpoint. The client knows their numbers. They understand what the payments will be. We have a game plan for down payment. Like we basically understand the next step. So all that's left to do is really the hard part nowadays, which is find the property and get an offer accepted. Right?
Yeah. No, I mean, sorry.
Go ahead.
No, I was just going to comment on the pre-approval. I mean, it's so important to get the pre-approval down just because I haven't seen a conditional offer go by my desk in quite some time. Everybody kind of has to go in firm. So you need to know what you can afford. And again, I'm not knocking on the banks. The banks tend to run you through a calculator, right? And every dollar's not equal when you're taking a mortgage, but they're kind of have these disclaimers and say, okay, well, you know what, this is how much you can afford, whether it's an investor or just a resident, if you're buying your first home, right? And it's not really until you've kind of put in an offer that they're looking at your profile and saying, okay, this is where the income is coming from, because that's important. And this is like where this is the actual situation. It's difficult for people to kind of really, through a bank at least, understand before they make that firm offer, how much can you really borrow?
Yeah, 100%. And people, not everybody understands the way the bank or the mortgage insurer is going to view their income. That's an important thing. People that make base salaries plus commissions, people that get paid car allowances, banks have rules about what amount of income, that you can use. So you're absolutely right. It's super important. When we take in a client's information, previously before the market was crazy, we would ask them, okay, well, how much is your income, right? And they would tell us, and we would run their numbers, based on what they told us. This was, again, 15, 20 years ago. It's changed a lot since then. But now we have to walk a line. You're right. We don't want to overwhelm a client with too many documents up front, because then people get upset. They don't want it. It's a lot of work up front. But you're absolutely right. There's a balance. We need to understand what income the bank is going to use. We need to collect, if you're self-employed, things like your T1s, your T4s, pay stubs, things like that. Very, very important, because banks will interpret income differently. So that's super important. That used to be done. Most people don't, if you haven't bought before, that used to be done after you got the house. Once you bought the house, then you would send in all your paperwork and verify everything. But it's just different now. Most of the hard work is done up front. You're getting your mortgage documents. Down payment is super important to the bank these days. They want a track record of where it's coming from. If it's being gifted, if you're buying a house, Harris, let's just say you're buying it by yourself, you're buying an owner-occupied house, and you're getting gifted down payment from family. Well, previously the bank would say, okay, get a gift letter signed and just show us the money going into your bank account. Well, now they can ask for a copy of the donor's account, right? People that aren't even on the deal. So down payment becomes super important, because guess what? If you don't like what's in the donor's bank account, they can start to ask questions. What's this deposit? What's this? So it's super, super important. Things people don't think about, right?
Yeah.
I had $5,000 cash deposit. I won money at the casino. I had a deposit. These are questions that can cause issues if you're not anticipating and clearing them up front.
Especially with, I feel like, first-time home buyers, because there's in Canada right now, there's a huge generational wealth being transferred from the parents to the kids who are helping, and if they open up that kind of can of worms, you really need to be prepared for it ahead of time, as opposed to when you've kind of entered into a firm contract.
Well, yeah. And I mean, I've seen banks turn down payment because it's coming from friends or it's coming from cousins, you as a mortgage or as a financing person, look, the point is, you're absolutely right. Okay. Most offers these days are firm, right? That's the reality of it. Now, as a bank or a mortgage broker, it's tough for us to ever recommend somebody go in firm. Why? Because no matter what I say about the client, there's two things that have to get approved, right? There's the client, which is the client's based on three things, right? Whether you're an investor, first-time buyer, the bank's looking at three main criteria, and you got to go 3 for 3 with these guys. One is down payment. Do you have the minimum amount, and is it acceptable to us? That's super important, right? Owner occupied, less than $1 million. The minimum down payment is 5% on the first 500,000, 10% on the amount above that. If it's owner occupied, that's number one. Do you have the down payment, and is it acceptable? Number two, credit. You have to have good credit. If you're going to a bank or you're going to a mortgage insurer, your credit has to be strong. If you have missed payments or collections, they can just decline you for that. So that's the two. The third, and sometimes most complicated, I don't say most important because you got to go three for three, but most complicated is debt service. And that's income versus debt. And that's the three things the bank is looking at for the applicant. I can clear all of that up front. I can look at your credit. I can check your income. I verify your down payment. That stuff I can clear, but I can't clear the property until there's an accepted offer. So property becomes supreme. Right? Things that can go wrong with the property is the condition of the home, the zoning of the home, the appraised value. So it's super important to work with not just a mortgage broker that you trust, of course, but a real estate agent that is able to give you that confidence. If you're going in firm, we don't have a problem with it, but the client has to understand what's at risk. They have to understand the risk if they're doing that. Because as you know, as the lawyer, who assumes the risk when they're in firm? Right? So they got to know that. So if there's an issue with the property, that's something I can't control if a client's infirm until an appraisal's done or the property's been cleared by the mortgage insurer. So again, it's not that I have a problem with anybody going infirm. I totally get the market, but market conditions don't take away the risk of a firm offer. That's all, right? So all the more reason to be prepared, as you were saying, have all that stuff cleared up front.
You have to like that. That's the thing. Like when you're going, I find like this is like you're going into battle, right? If you're going into battle, you want like the strongest men behind you because and the right advisors. Doesn't mean you don't fight the fight, right? It just means that you know what you're going up against and you know you've got the right people behind you, and so you're facing it more confidently, and then
No, I don't mean to cut you off. I was going to say, and that's ultimately the value of, having a great team. And that's, we say all the time, lawyer, realtor, mortgage broker, insurance, build a strong team of people. You don't always buy the cheapest car or the cheapest television. You buy what, security, you buy what works, you buy quality. That's, that's what we believe.
And back to like the conversation about like rates and all of that, I find like if you have, for example, and this for me is kind of what I see. It's a little bit mindless, and I always tell anybody in this situation to go talk to a mortgage broker because people will often come and say, you know what, my credit is not the best for me to go to an A lender and get like the best rate. I'm like, well, how much interest rate are you saving, and how much is real estate appreciating? Are you really saving anything, or are you going backwards? Right.
Oh man, we get that all the time. It's something that sometimes is eye-opening. You're right, to the self-employed people, right? That's the problem. Sometimes with credit or with self-employed people, right? They're not falling in line with what the bank is, looking for in terms of an approval. So a lot of the times it's a shortfall on income for self-employed people. Being real, right? They're not showing the taxable income. So a lot of them will say no to B lender. They'll just say, look, I couldn't go to an A lender. I guess I have no options. B lenders are too expensive. I don't want to go there. Well, here's the interesting thing about a B lender. So for those that don't know, a B lender is a lender that doesn't look at income the same way as an A lender. An A lender is pretty black and white. They want your taxable income, a 2-year history of your taxable income. We know your business or your corp may make more money, but we want to see your personal income. That's how they're qualifying. Right? That's what the big banks are doing. So the problem for the self-employed person is they're usually not showing enough to cover that sort of debt service ratio I was mentioning. So they don't think they have a choice. But when you actually start to compare, this is the interesting thing about the market these days. When you actually start to compare, it used to be a big difference of interest rate, right? B lender, A lender is a big difference. Now it's almost the same. When you start comparing a 1-year term with a B lender versus a 5-year fixed, you compare fixed to fixed rates because variable, there's still a bit of a discretion. But when you compare a 1-year fixed rate with a B lender to a 5-year fixed rate with an A lender, it's almost the same these days. So how much are you really talking in terms of monthly payment difference to go to a B lender, right? Maybe a $500,000-$600,000 mortgage, you might be talking $200 a month. So you start doing math and you go, you're right. A B lender, if it's, a little bit of a higher, I'm just saying 200. That's just, sort of a,
we won't hold you.
You're right. So, but imagine after a year, that's $2,400. As you said, what do you think the house is appreciating? A B lender also charges a 1% lender fee. So if you're borrowing, say, $600,000, they're going to charge you 1% on the loan amount. So all in, your cost difference potentially for 1 year with the B lender might be the lender fee of $6,000 plus if you say $200 a month, you're talking $8,400 a year.
Yeah.
All in for the B lender. And guess what? People will say, yeah, but you said a 1 year term, Dan. Do I have to pay that fee every year? Not with the B lender. On renewal, they don't charge you the lender fee anymore. So now it's just a difference of interest rate. So the question to the self-employed person who you mentioned before, might be focused on, well, I want to be able to say I have the lowest rate. Well, the real question is they want to save the most money. That's what people are asking. And the self-employed person's answer may not be to go to an A lender to get the best rate, because what's going to cost them more? Claiming the amount of income they might have to claim to go to a bank, or going to the B lender and having a little bit of a higher rate and paying the lender fee. So don't, there's a saying, don't bend over dimes to pick up pennies. You got to look at the big picture, especially when you're talking real estate and, this sort of divide that's happening, that we have such a shortfall of inventory and such a massive amount of demand that's penting up for sure.
And I've seen like even smart, intelligent business owners who are like contemplating raising, like, to have to declare more income in order to go to that A lender. And my process, I think, is like, how much taxes are you going to pay, right?
Yeah.
How much taxes are you going to pay? And then if you want to like do that next year, then your house that you're buying is appreciating, and there's so many, like, you're just kind of walking backwards. It's insane. But yeah,
we'll tell clients that. Well, we'll set up in a sense, we'll set up a meeting and we'll say to them, look, we'll tell you what you'll have to claim, because that's easy for me, right? It's a formula from the banks. This is what you can use for income. It's either an average or sort of a history, depending on what the numbers say. But I can tell you as a client what you need to pay yourself to get your numbers line. And when you tell people the amount of dollars in taxes they may have to pay just to get best rate, it's a no-brainer. It's a no-brainer. So it's an easy sell. I don't have to do anything on those numbers themselves. But I get it. I mean, look, they want what everybody else wants, which is a low rate. I get that. It's not lost on me. But the real question is, who's saving the most money? That's the real question.
Yeah, and the thing is even with the lowest rate, let's say you qualify for the lowest rate, doesn't mean, and I'm going to change gears with this a little bit, doesn't mean that you should be going for it, because with fixed rates, it's like if you break it, the penalties are insane. And I've seen like everything under this, like we've seen people paying 60, 70,000 in penalties. And I'm just like, what, like what's going on here? And just so that you could save $200, $300 a month, you're paying this $60,000. And it's more often than you'd think, because and again, you'd know this better. I don't know how many Canadians stick it out the entire 5-year term. So I feel like it's what, 60% or what, like
most don't. Yeah, most will change their mortgage in some way. And you're absolutely right. This is a question I get a lot from clients, right? Well, should I go fixed or variable? And I always suggest variable. Listen, I'm a fan of fixed rate. I've taken fixed rate. So there's nothing wrong with a fixed rate. But why do I suggest variable? I love variable because of 3 things. 1, it's a lower interest rate, right? Generally, variable is lower than fixed. That's the way it works. There was a bit of an inverted yield curve a couple of years ago where that sort of changed for the first time. But generally, it's a lower rate. You look at today, you're still 1.5% lower than a fixed rate. So I love that it's a lower rate. Number 2, I love that I can lock it in, right? You can lock in a variable rate to a fixed rate. So if I'm wrong, and let's say rates drop, I can actually flip my variable into a fixed rate with no penalty. So you can't go from fixed to variable, but you can go from variable to fixed without penalty. So I like that I have that. But most importantly, and you touched on this, is the penalty. Okay, when I'm in a variable rate, the penalty, for the most part, you have to check because sometimes there's little clauses with some of the smaller lenders. But for the most part, with a big bank, your penalty is 3 months interest. So you can bank on your penalty. You can look at your amortization schedule. You can do some quick math and figure, okay, if I'm at 2%, 2.5% the rate, my penalty is half my mortgage payment times 3. That's basically what your penalty will be. So if you have a $2,000, mortgage, you're going to have, what's that, a $3,500 penalty.
Yeah, it's nothing.
Right? Yeah. Not a big deal. Or $2,500 penalty, so not a big deal. So when you have a fixed rate, this is where the penalty can start to affect you. The rule with the bank is when you have a fixed rate, the penalty is either 3 months interest or interest rate differential. So it can't be 3 months interest, but they slip in this clause that says, or interest rate differential, whichever is greater at the time. That's the contract. So what is interest rate differential? We'll look at it like this. In 2018, mortgage rates were around 3.79%, right? 3.79%, not far off from where they're at right now. This isn't recorded, right? It's not going to be so don't quote me. Let's just say roughly around as of today. But they were like that in 2018, okay? Right around 3.79 to 3.89. Well, when COVID hit in 2019, right? I'm not sure if you noticed this, but you probably do. You're a smart guy. Interest rates started to drop, right? Interest rates went down from 3.79 all the way down to, like, some people got under 2% on a 5-year fixed rate, if you can imagine, 1.89, 1.99. So all the people that had 3.79%, rightfully so, had the bright idea, well, why don't I just break my 3.79% mortgage and go refi it at 1.89% and lock in a new rate? Well, this is where interest rate differential comes in, because interest rate differential means the bank is going to calculate your interest rate that you're locked in for 5 years. Okay. So 3.79. Then they're going to take the mortgage balance that you owe, and they're going to figure out through this math formula how much money they're going to lose now by having to re-lend your money out at today's lower rate and over the amount of months that's left on your mortgage. Okay, as a basic way to describe interest rate differential. So that's why you will see such massively high penalties. It's when you're locked into a higher rate and rates are lower at the time you want to break the mortgage. That's when penalties are massive. Now, it works the other way. The banks are smart. They're a business. So what do you think they offer you when rates are higher, when those people with 1.89 want to come back and refi and break their mortgage, but the rates are like 3.79? Then the banks will give you the beneficial penalty. They'll go, well, wait a second. We can break this 1.89 mortgage rate, lend that money back out today at 3.79. Let's let the client out of the mortgage and just lend that money back out. So it's smart as a business. It's not bad. You got to remember, this is how the banks think. This is what your contract says when it comes to penalty. So for a long-winded answer, which I apologize here, the penalty on variable, you always know it's 3 months interest. There's no surprises. Fixed rates, it's either or. It depends on what rates are at the time.
I mean, essentially with that differential, they're taking away any savings that you have. It completely just 100%. Wipes out any savings. So,
more. It won't. The math never adds up. Well, does it make sense to pay the 30 grand? Will I make that back? The answer is no. The math rarely, I can't even imagine off the top of my head a time I was like, just to break it. Now, maybe when you're consolidating debt and you know what I mean? You want to lower people do pay the penalty. There's reasons to pay it, and sometimes you can save money. I have a renewal this year. Right. And I got offered a year ago, Scotiabank, who's a great bank. I love Scotia. They offered me a really good renewal. It was somewhere around 2%, but I would have had to break my mortgage at the time. So they were like, look, you can refi it early. You're going to pay 15 grand penalty, but you're right. You can lock in at another 5 years at 2%. So I didn't want to do it. I didn't think it would, I'll just wait. I like variable anyways. I'm going to go variable. But I mean, you look at that rate today, that's like almost 1.5% higher, roughly. So, sometimes it can make sense. If you're able to predict where rates are going to go, it can make sense. But it's usually a tough call to just break the mortgage to get a lower rate.
I'm a variable guy. I don't think I've ever taken a fix. There's something like anything can happen in life. You may need to, you need to move. You need to take out money for whatever unexpected expenditures. It makes sense. And I don't think I have seen over a 5-year period, at least, fixed outperform variable. So
small window. There was what's called an inverted yield curve. And this is what happened when everybody got locked into like 369, 379. I think it was 2017 or 2018. But variable rate it was the first time in Canada that I'd ever seen. I've been doing this for almost 20 years now. But variable rate was higher. So when I say to you, here's the 3 things I like about variable rate, imagine me taking away the fact that it's a lower rate, right? Who's going to take it? So most people took fixed rates at the time, and then the discount to variable changed, COVID hit, rates dropped. So all those people that had fixed rates got stuck, in a sense, stuck. Now, in perspective, 379 isn't a bad rate when you're doing it long as me.
Yeah.
I remember, I sound like an old guy here, but I remember, 5%, 5.25%. When they dropped below 5%, I was like, this is crazy. It's like free money at like
Yeah.
4.79. So we're still relatively good. Like you, variable rate is still, really low. We do anticipate it going up. So that's something people should prepare for if you've got a variable rate. But I agree. If you look at the history of Canada, variable rate 99.9999% of the time outperforms fixed rate. There's no doubt about that.
Yeah. And just to wrap it up, last question. It's a crystal ball question here for you, so you got to take that out. There's so much talk about rates going up. We've bumped, I guess, the Bank of Canada brought it up 25 basis points. Some argue they're going to push it up 7 times. I don't know how valid that is. Where do you think rates are going to be December 2022? And would you still be pushing variable over fixed, knowing where the trajectory is?
Yeah, I think variable rate, you're still pretty secure. I mean, you're right. Listen, I openly tell people I'm done with predictions because it's been pretty tough. But I think we're pretty safe to say it will go up. Like if I was a betting man, it's going to go up. The question is how much. I think 7 times would be pretty excessive. I think that would cause quite a bit of chaos for affordability. I don't know if the government is looking to do that to people, but I certainly think up 0.5 point is a reasonable number. And I think if you're doing the math today and you're comparing a variable versus a fixed, 0.5 point is still significantly lower than what a fixed rate would be. So I would still suggest variable, that cushion of increases. You have to have the stomach for it. That's the one thing I would say. First time buyers maybe don't have the same stomach. First time buyers like security. They want to sleep at night. And when you like those things, you pay a bit extra for fixed rate. And there's nothing wrong with that. It's still a good rate. But if you're asking what's the lowest rate, I would venture to say it's going to be variable. And for the other reasons I mentioned before, especially with investors, the ability to break it, the ability to lock it in if we're wrong. I just like the flexibility. I would recommend variable for sure. But I can't argue against fixed rate. It's all about how you sleep at night.
I think with the first time buyers, they haven't seen the market long enough to understand where interest rates are going and how everything reacts. That's right. So, but That's right. Thanks for everything. Thanks for all the information. If anybody wants to get in touch with Daniel, I'm going to leave his contact information below. Thanks for coming on the podcast again. Thank you for your time.
My pleasure. Anytime, Harris. I appreciate it.
Take care, man.